some of these investors do not understand the small cap space. How do these small companies deliver a big impact, which is even bigger as compared to the large cap?
They become large caps over a period of time.
Small caps having delivered about a 40% return over the past 1 year. इस टाइम पर अभी डर लगता है कि कोई नया स्टॉक खरीदा या एग्जिस्टिंग स्टॉक में पैसे डाले तो 3% करेक्शन ना हो जाए. Hello viewers, this is Shalini Gera. Welcome to our very first collaborative podcast with Sahil Shah over here. Today we will be talking about a topic which is very, very close to my heart. When I interact with our investors, a lot of our investors have questions to ask us. Some of these investors are not aware as to what are small cap companies. Some of these investors do not understand the small cap space. They think that small cap companies are so small that they are going to get delisted shortly. Some of these investors having seen the last 1 year rally in the small cap space. And for a context, small caps, Nifty small cap has performed 40% year on year growth over the past 1 year. Nifty mid cap has delivered a 38% growth over the past 1 year. And Nifty 50 has delivered a 12% growth over the past 1 year. So a lot of our investors, when they see the growth that small caps have delivered in the past 1 year, are now concerned about stepping in the small cap space. They think that it's better to stay with the large caps, stay safe with the large caps, and avoid the small caps at this time completely. And a lot of our investors who have been invested in the small cap space prior, they want to exit the small cap space and they want to book the profit. So to address all of these investors' questions, today we have Mr. Sahil Shah with us. Sahil is the fund manager for Edelweiss Small Cap Fund. Sahil has been associated with the Edelweiss Asset Management Company since 2015 and with Edelweiss Group since 2007. Welcome to our show, Sahil.
Thanks, Shalini. Thanks.
How are you doing?
All good. All good. How are things at your end?
Absolutely fine. Thank you very much. So, Sahil, I do like to do my research on various topics before starting these podcasts, and I noticed that your fund's tagline is small in size and big in impact. So the very first question that I want you to address is, what are small cap companies in very, very layman language? And how do these small companies deliver a big impact, which is even bigger as compared to the large cap companies?
Sure. So small caps are typically defined as companies which have a market cap rank of less than 258. So basically, if I have to rank order the companies in terms of market cap, the first 100 will be large caps, 100 to 258 company will be a mid cap, and less than 258 will be the small cap. That is how AMFI, which is an industry body that defines the small caps in India. Now, typically, this market cap range of small caps goes up to as high as 18,000 crores, right? So while the name is small, there are companies, a lot of companies, which are about 10,000 crores of market cap in the small cap space. So that is the definition of small cap, and it can go down to as low as 500 or 1,000 odd crores. Now, coming to your second question on how does small caps deliver bigger impact over a period of time? I think small caps have two things. One is that the earnings growth is faster as compared to large caps. So if you buy a good quality small cap, a good business in small cap space, typically you will get a faster earnings growth as compared to large caps. And there is a price earnings multiple re-rating potential. So there is a valuation re-rating potential which small caps inherently have, because they are small in size. They are less discovered as compared to large caps on a relative basis, and hence there is a re-rating potential which is available in terms of valuations. A combination of faster earnings growth as well as valuation multiples re-rating, that gives a higher return in terms of small caps over a longer period of time. So for example, if a company, if you buy it at, let's say, 30-40 times in terms of price earnings multiple, the chances that the multiples will re-rate to even a higher level is on a lower side compared to a company which has same business, same return on capital, and almost similar kind of quality, which is bought at a lower multiple, that has a chance to re-rate. Now, returns are nothing but a function of re-rating, that is where the valuation multiples are versus what they will be in the future. and the earnings growth that is delivered in your investment horizon. I think a combination of both of these things give you a much higher return in small caps as compared to large cap over a longer period of time.
All right. So investors, small caps are not necessarily small companies. They can be as large as an 18,000 crore kind of a company. And two broad reasons we've identified. One is the re-rating multiple, that means the valuation going up from, let's say, a 10x to a 30x. And then the increase in the corporate earnings over a short period of time is what gives the large impact. All right. Sahil, so your Edelweiss Small Cap Fund has delivered a 29% CAGR over the past 4 years since its inception. Congratulations on that phenomenal return in the equity space and the small cap space too. So why don't you tell us about some of the contributing sectors that have delivered these success stories, and how have they delivered?
Yeah, sure. So in terms of the returns are also a function of where the market was in 2018 and where it is today. So it has to do with markets as well as the stock selection board. And in terms of the sectors that have delivered or that have contributed to these returns, one is capital goods. So that is one sector which has kind of contributed a lot to the returns that you are seeing. Second is building material companies in our portfolios. Third is healthcare stocks in our portfolios. And last, some of the electronic manufacturing services companies which are a part of our portfolio. So if you look at these themes, these are the themes which have been playing out over the last 3 to 4 years. Capital goods was under serious problem for last many years after we saw a super cycle of capital goods in 2003 to 2010. Then it went for a null period for a decade. And now it has again kind of come back. So capital goods did very well, and within that, the stock selection that we made has contributed to our returns. Again, the real estate had similar patch, a super cycle between 2003 to 2010, followed by a lull, and now we are seeing a revival in real estate. So the real estate ancillary is nothing but the building material companies, right? Companies which are into manufacturing of pipes, tiles, plywood. So those companies have kind of contributed to returns. Some of the structural steel tubes companies which are part of the portfolio, those companies have delivered good alpha in our portfolio.
And these have delivered well throughout the past 4 years?
Yes. So 3 to 4 years on the time horizon that you talked about, I think these are the sectors which have contributed good returns.
Sahil, there are almost 6,000 plus listed stocks on both BSE as well as NSE and in our entire listed universe. What is your way of selection of, let's say you have 73 stocks in your small cap fund at the moment. What is your way of selection of stocks? And I'm sure this must be going beyond the ordinary reading of the balance sheet as well. So why don't you tell us about your selection criteria?
Sure. So while there are more than 1,000 stocks in the listed space as far as small cap is concerned. And as I said, anything which is below market cap rank of 258 classifies under small cap. So in a way, there is a long tail of small cap companies which are classified as small caps. Now, the first filter that we always put in is the market cap criteria, because as a fund, you also need liquidity in stocks. And liquidity is one of the major focus areas that we have in our fund. So typically we don't buy companies which are below 2,500, 3,000 crores of market cap, and that shrinks this 1,000 plus kind of stock universe to 500 stocks, right? Now out of these 500 stocks, we apply accounting quality checks, managements which are which do not have any checkered past in their in the history of their operations. So those checks, when we apply accounting quality checks, what we call as forensics checks, those companies reduce from 500 to 350 odd companies. Now that 350 companies becomes our hunting ground in terms of in the companies from where we kind of select our stocks. So the way we select our stocks is basically where we use our FAIR framework. So FAIR is an abbreviation, which means F stands for forensics, A stands for acceptable price, I is investment style agnostic, and R is robustness of the business. So once we are through the accounting quality checks, which brings down the overall universe to 350 odd stocks, then we look at which businesses will deliver good earnings growth and good return on capital with good cash flows over in the medium term as well as in the long term, right? So once we are clear about that, that is what then again the universe further shrinks to almost 150 to 200 odd stocks, right? And from there we kind of pick stocks which forms the part of our portfolio. So there is a rigorous method which looks at liquidity, quality of accounting, and then checking the robustness of the business, and finally the valuation, which basically leads to those stocks to be part of the overall portfolio.
You talked about liquidity. I'm more interested in this. How do you determine the liquidity of the stock? What is your criteria for selection of a liquid stock? And I'm going to add a subpart to this as well. So when you buy into a stock, you would be buying in bulk naturally. But how about the exiting part? So when you exit it, are you able to find buyers to offload all of that stock? If not, do you end up exiting in phases?
Yeah, so liquidity, see, typically there is no specific number that we look for in terms of liquidity. Typically, wherever the liquidity is on the lower side compared to some of the other stocks that we see, we will have lower weight in the portfolio as compared to stocks which are more liquid. We will have a higher weight in the portfolio. And the weightage is not only dependent on how the liquidity is, but also the conviction in the idea, depending on where the business is going, how the valuations are, and so on. But even if the conviction is, let's say, on the higher side, if the valuations are also favorable, but let's say if the stock is illiquid or less liquid, and if it is above 3,000 crores of market cap, we will try and restrict that weight to 1% or somewhere around 1%, so that if we have to kind of liquidate, it does not impact the overall portfolio. That is the whole idea. Now, coming to the exit strategy, or how do we exit the stock, or whether we find buyers when we are trying to exit a stock, I think if you look at the liquidity profile of our portfolio, almost 85% of our portfolio can be liquidated in less than 5 days. Right? Mm-hmm. Now, this is a very, I would say, an outlandish assumption we are making, that almost 3,000 crores of AUM will come up for redemption. That doesn't happen. But if it were to, which we never wish that it would ever, but if it were to, we can liquidate 85% of the portfolio in less than 5 days. This is after taking into account 25% participation on the daily tradable volumes, right? So we are not saying we'll participate in 100% of the volume, because that is not something which is practically possible, right? So based on looking at what practically possible is, and then trying to say that what the overall liquidity profile is what this number comes to about. So that's how we kind of look at liquidity.
Sure. You talked about a fair strategy of selection of stocks. So apart from the forensics and the accounting practices and the balance sheet and the desk-based research, do you go beyond that as well? Do you do any kind of a groundwork research, speaking to the management or some other entities in the market to shortlist a stock?
Yeah, absolutely. I think going beyond desk research is very important as far as small caps are concerned. So we speak to experts, we do plant visits, we meet a lot of suppliers and buyers of the companies that we are evaluating. This is to understand, because we as outsiders can know not most of the things which are kind of there in the company, right? So to kind of understand the intention of the management, it is very important to kind of speak to people who are in the industry, especially who are in the unlisted space or who have worked in those companies in the past. And that can give us true picture about that particular company. So we do a lot of ground checks, channel checks before kind of investing in a company.
Very, very thorough research going into selection of stocks, speaking to the management, buyers, suppliers, and doing an entire channel recce. All right. Sahil, we like to make our content as transparent as possible. So we have talked about some of the success stories, what contributed to the success of the fund. I'm sure there must be some mistakes that you may have made in the past while selection of stocks. Would you like to talk about those, and what did you learn about small caps from those mistakes?
So I think, and that's a very important question in my opinion, because it is never that we have 100% success ratio in what we kind of buy. But if we learn from our mistakes, we can keep improving our success ratio over a period of time. So I think the mistakes typically happen in two areas. And that is where there is a big loss of capital that happens. One is to kind of identify the changing competitive landscape in a particular industry. So let's say if you are kind of positive on a particular company, and if you have that in your portfolio, if you cannot perfectly kind of at the right time, if you're not able to find, or if you're not able to identify the change in the competitive landscape in that particular industry, then there can be serious erosion of capital that can happen. Because what competition does, even with great managements that we have in our portfolios or otherwise, is that basically it will really bring down the overall profitability and margins of that particular company, right? So that is the change in competitive landscape is something that one should identify not only while investing in the portfolio, but also in the stocks which are already there in the portfolio. And that is where I think mistakes happen. The second is that while we enter in a stock by doing all the accounting quality checks and how the management has treated minority shareholders in the past, sometimes the change of management attitude toward the minority shareholders is something which we cannot foresee, right? But when that change happens, that is where we should act quite abruptly. And that is where I think mistakes are made, when we kind of give some leeway to the management who has changed their capital allocation policies or their attitude towards minority shareholders. So I think the broader mistakes happen in this kinds of area. Apart from I would say some of the smaller mistakes that keep happening in terms of forecasting error. So let's say if I'm forecasting a growth of 30% for a company, and that company delivers 20% growth, obviously there will be some drawdown in the share price. But these are, I would say, some minor mistakes for a long-term investor. But I think the major mistake that happens for a long-term investor is what I talked about.
So apart from just being focused on the company, you all have a close eye on what all their competition is doing. Is a new competitor coming up? Is it reflecting in the market share of the existing company that you've selected or not? And Absolutely. to evolve accordingly. I think that's Absolutely. What more of your earlier mistakes, and that's what you've learned and evolved on.
Yes, absolutely.
Sahil, this is from your perspective, a fund manager's perspective. Let's also consider the other side of the desk where an investor is sitting. Where do you see small caps being an investor's financial plan, A? And B, what is the value that the small caps add over large caps in a person's financial plan?
So I think any investor or a client who is looking for higher returns, obviously higher returns than large caps, has to kind of have allocation to small cap as a space. But more importantly, small caps and mid caps in general give you certain opportunities and certain themes which are less available in the large caps. So for example, some of the consumer discretionary theme where we keep talking about that India is at a per capita GDP of roughly around $3,000. And if we are kind of moving in terms of per capita GDP, then obviously the consumption of staples is not going to increase at a pace at which consumer discretionary items growth will be there over the next few years, right? So a lot of these consumer discretionary names are available in small caps and mid caps and not in large caps. Similarly, some of the emerging themes, like let's say, for example, electronic manufacturing, right? 7 years back, it was chemicals, China plus one, right? So those themes typically fall under small and mid caps and not under large caps. They become large caps over a period of time. So if a client or an investor wants to participate in high earnings growth companies, typically which are growing at, let's say, 1.5x or 2x that of nominal GDP growth, and they can take higher risk in their portfolio, along with these themes which are there, which are hardly available in large caps, is when one should look to diversify away from large caps within equity.
What I've also observed is large caps will typically account for the banks, automobile companies of the world, and they will restrict a person to about 14-15% kind of a CAGR over the long term too. If a person is looking for enhanced returns, you're looking for themes like consumer electronics and consumer durables and electronics, That's where the small caps are. So Sahil, now small caps having delivered about a 40% return over the past 1 year. Now, when you look at buying additional stocks or even putting money in the existing stocks, इस टाइम पर अभी डर लगता है कि कोई नया स्टॉक खरीदा या एग्जिस्टिंग स्टॉक में पैसे डाले तो 3% करेक्शन ना हो जाए कल जैसे हुई थी.
Yeah, I mean, in small caps, as a small cap manager for last many years, and having seen through the cycles, obviously, I mean, one has to build an appetite for at least a 10 to 15% drawdown in small cap, which can happen at any point of time, whether it is stocks or whether it is at index level. And it can happen more at the stock level than at an index level. So obviously, that brings me to the valuations part in terms of where are we in terms of valuation cycle. Now, if you look at at an overall index level, small caps currently are at around 25-26 times in terms of price earnings multiple. This is all trailing 12-month multiple that I'm talking about. The long-term average has been at around 18 times. So we are already one standard deviation or above one standard deviation as far as the valuations are concerned. So we are not in a market where we can say that there is a margin of safety in terms of valuation that is available. Now, that makes me believe that at least over the next 1.5 years, even with all that factors that global investors want to kind of put money into India, there is earnings growth which is going to be there, which is much faster than most of the other developed economies or even the other emerging economies. There can be a time correction is what one should anticipate. The kind of returns that we have seen over the last 4 years has been a function of also the low base. So as you would remember that in 2018-19 there was a correction which was followed by a big bull market that we saw post 2014. So we started off from that low base and now we are on a slightly higher base. Maybe possibly we started with a price earnings multiple of 12-13 times at that point of time. Now we are at 25 times with the earnings growth which has also come through. So we are not at those low levels where we can anticipate another 3 years or 29-30% compounded returns, right? So one should trim down their expectations in terms of the returns that we are seeing from small caps. While I do believe that over next 3 to 5 years, within the equity class, small caps will still continue to deliver better returns as compared to maybe a large cap, right? And the reason is that the earnings growth differential of small cap versus a large cap will be somewhere around 4 to 5%. Now, as you know, that share prices will be a function of how earnings will grow. And if there is an earnings growth differential of 4 to 5%, that should obviously translate into share prices over a longer period of time as well. So there is no doubt that small caps have kind of lost their sheen because they have run up so fast. But maybe there is time correction is what one should anticipate. And the growth rates, of course, over a longer period of time should be higher as compared to large cap, as it has been the case in the past.
One point you made is that the kind of returns that we have seen in the past 1 year may not likely continue for the next 1 or 2 years. Some kind of a time correction is definitely likely to occur, which in my view is also a good opportunity for investments into the small cap. So
Absolutely.
Investor expectation from the short-term perspective in small caps should be trimmed down. They may not be what they've seen in the past 1 year, but from a long-term perspective, an additional return, enhanced return over the large cap space is definitely visible. You talked about this correction, major correction in 2018-19. Now, a lot of our investors have entered into the stock market in 2020 after seeing the bull run, post the COVID run. So, इन्वेस्टर्स को अगर बोलो कि स्मॉल कैप्स ने नेगेटिव रिटर्न दिया था किसी टाइम पर तो उन्हें विश्वास ही नहीं होता है. So Sahil, I want you to address that part. Why was it that small caps were delivering the negative return in 2018-19? And the sub part to this question will be, what should an investor do in such testing times?
So typically, whenever there is a liquidity squeeze that happens at an overall level, is when small caps tend to deliver or negative returns. So if you look at, there are two factors. One is the starting valuations that we are talking about. So, if you would remember, in calendar year of 2017, there was almost a 50-60% increase in these in terms of the returns that small caps have given, right? So there was almost a 50-60% returns that small caps delivered in 2017. Now that led to valuations at around 30-32 times in 2017, right? We are currently at around 25 odd times. So now they were already 2 standard deviation, 3 standard deviation above the average. And uh, typically, whenever there is some bad news which comes at such a high valuation, obviously the correction is also tends to be much steeper. So, as you would remember, in September 2018, there was an Ireland FS crisis that happened, which was followed up by some of the banks and some of the NBFCs, which also kind of went, I would say, belly up, right? So that led to a lot of problems in the small cap space. Now, so it starts with high valuation, uh, and the bubble kind of becomes bigger, and there is something needs to kind of blow up that bubble, and there are this kind of negative news that comes up. The second is the liquidity in small cap, right? So it is not that the earnings of the small cap companies would have declined by 30%, and the reason why the index also went down by 30%. It is also to do with starting valuations and also the liquidity in the small caps, which is on a slightly lower side, which leads to a fall which is more than what otherwise fundamentals would warrant, right? So that leads to such kind of negative drawdowns in the small cap space.
All right. One, you talked about the base itself being very, very high in about 2017 or beginning 2018, which led to that sort of a correction. We were already sitting at a 35, 37 kind of a multiples in the small cap space. And then you talked about the liquidity crisis, large companies, including an ILFS crisis, which had happened, which led to troubles in the small cap space.
Correct.
Right. Next, Sahil, last 1 year, 40% returns. Everything seems to be doing very well. So, in that kind of a time, how do you segregate the men from the boys?
No, that's a very important question. In fact, a lot of low ROE stocks, a lot of low quality stocks also participate whenever there is this kind of bull run that happens, as what we have seen in 2013, 2023. So typically, the way we kind of separate men from the boys or separate wheat from the chaff is basically by going by the same method that we had discussed about, the framework, the FAIR framework, where the accounting quality plays the most important role whenever we want to kind of onboard a stock. The second is liquidity. So if you remember, just now I just said that in 2018 it was not only about valuations, but it is also because of liquidity that small caps fall more than mid caps or large caps, and there is a drawdown. And the similar reverse thing happens on the upside as well. Right? Small caps will rise much faster than the large caps or mid caps. So if we have liquidity, accounting, quality as a criteria, then obviously the chances are less that at least we will face a lesser drawdown as compared to the overall market.
All right. Sahil, I realized we had missed the second part of the last question. So when an investor does see negative returns in the small cap space, तब उन्हें वो क्या करना चाहिए? बहुत सारे investors small cap से निकल के large caps में चले जाते हैं. Is that the right attitude?
So typically, what we have seen historically, whether it was 2018, where there was an actual negative drawdown almost by around 30 odd percent, 30%, or in let's say calendar year 2022, where there was a time correction which happened, right? So there again, small caps went down by 12-13%, large caps were up by 2-3%. So there was an underperformance of small caps versus large cap very recently, right? Typically, what we have seen after such underperformance or actual negative drawdown is that the next year or the coming 2-3 years deliver very good returns for the small cap investors. Okay. And we have seen this kind of repeated time and again. So whenever such kind of opportunity comes in, I would suggest that obviously at that time the emotions are such that people want to kind of get out of small cap and get into large caps. But I think that is the point of time when one should be kind of investing more into small caps. And maybe these are the times when one should be getting slightly, I would say, reduce the allocation in small caps.
All right. And Sahil, this is something that I've learned from your CEO only. Whenever a stock or a fund is giving negative returns, unless and until, first of all, if you need money for your financial goals, and secondly, there's something wrong with the particular stock or with the particular sector, unless these two things are there, you should not be exiting that particular fund or that particular stock. Because when you do so, you turn your losses, which are only notional at that point of time, into real losses.
Absolutely.
And you book those losses. And secondly, you also lose out on the opportunity to convert those losses into gains. So, rightly put, you should actually utilize such times to build positions in that space as compared to coming out of that space.
Absolutely. Absolutely.
Next 5 years in small cap returns, kahan dekhte hain aap?
So as I said, the returns that we have seen in last 4 years are unlikely or less likely to be repeated in next 5 years. And it is very difficult to put a number to what kind of returns small cap will generate over next 5 years. But I am very sure that small cap should deliver returns which are higher than large caps, at least. And given that the kind of growth rates that we are seeing in a lot of these small cap companies, whether it is capital goods, whether it is building materials, whether it is some of the electronic manufacturing companies, I believe that typically we have seen that over a longer period of time, earnings growth and share price returns are kind of almost similar, right? And if earnings growth are going to be, let's say, 1.5 times that of GDP or 2 times that of nominal GDP growth, I think that is the trajectory of growth that one can anticipate from a small cap fund.
So earnings growth is definitely on our side, and that means that small caps are always going to perform better as compared to large caps over the long term too. Now, Sahil, a very honest answer that I'm looking from you is you have 1 crore rupees to invest and you don't need it for the next 5 years. Will you put it all in your small cap fund?
No, so see, I mean, as an individual, if I have a risk appetite, I can put everything in small and mid cap fund. But typically, what we suggest for clients to do is, depending on the risk appetite, whether it is a risk averse investor versus an investor which can take very high risk. Typically, a small cap allocation should be somewhere between 15 to as high as 35%. Because see, at certain points of time, we have also seen that large caps also perform, right? In certain markets, mid cap can also perform. And that is the reason why I believe that diversification is important. And the typical allocation that we suggest is somewhere between 10-15% to as high as 35% in the small cap space.
All right. So you've taken a very diplomatic and investor-friendly view to rightly maintain an asset allocation. That is also something that we continue to emphasize upon. A good approach will be somewhere between 15 to 30% kind of a small cap allocation, depending upon your risk appetite, of course. But diversification is the key to achieving your goals in the long term. Then, Sahil, that was my last question for you. Thank you very much. It's been very exciting and fun talking to you on the small cap space. It's a topic very close to my heart. Investors, if you did like this topic, please don't forget to subscribe to our channel. It means a lot to us. Do let us know on what other financial content you would want us to talk about. I will be coming back to you with more such financially relevant content. Till then, this is Shalini Gera signing off. Thank you very much. Bye-bye.